Aren't you not afraid that most European equities are so internationally diversified that most of their exposure is from overseas?
Well, if you look carefully at a lot of European equity markets, one of the interesting things that you will find is that they derive a lot of earnings from the Eurozone in certain markets, like Spain, like Italy, a lot of earnings are domestic. On the other hand, you look at countries like Germany, a much larger proportion of earnings come from the United States, from emerging markets, from China. So it's pretty diverse and it varies quite a bit from market to market. But the overall theme that we are expecting to play out in 2015 is that a weaker euro will help European companies. The quantitative easing will probably help a lot of European banks. And then you will see probably an improvement in demand in Europe after, by now, about 4 years of weak economic conditions in the region. So in some sense, we're expecting that Europe is likely to surprise on the upside in 2015.
Okay. You told us that you think the US equities are still a bit undervalued, although they are still at extreme record levels, like the S&P 500. Why do you still see upside despite the record levels?
Well, to be very clear, we think that US equities will have weaker performance in 2015 than they did in 2014, and we have reduced our overweight to US equities. One of the reasons for that is the fact that we expect the dollar to strengthen. And remember that despite the benefits of weaker oil for the US consumer, a weaker oil will hurt the earnings of a number of US companies. And so we think the US is not as attractive as it was a year ago. We've reduced our exposure to it. But overall, we still favor equities in most of our portfolios, and that translates into some overweight to the US equity market being one very large component of global equity.
The final questions about the higher volatilities in the equity markets. How do you anticipate on that?
You know, I think volatility will continue to be, relatively speaking, high because, as you know very well, volatility in equities and in many other asset classes has been lower lately than it used to be many years ago. So I think the trend will continue, and to a large degree, this is a function of many players today in the volatility space. But the volatility of volatility is what is high, and this is what we expect to continue in 2015, where you could see big spikes in measures such as VIX, but at the same time you will see that those measures will come down very quickly and then maybe rise again. Nevertheless, we think this would be an opportunity for a tactical manager, like we do for most of our portfolios, where volatility could provide an opportunity to increase exposure and buy on weakness.